Hey everyone, my name is Ayush from Astrios, and today we'll be discussing what the stock market is and how you can take advantage of the stock market to make money. So let's dive right into it. So, what is the stock market? To understand the stock market, we first have to understand what stocks are, right? So, let's dive into what stocks are and how they function. So, stocks are a form of security that represent ownership of a publicly traded company. And in buying a certain number of stocks or shares, you are able to own a proportion of that company's assets and earnings. And the more ownership you have, the greater control and influence you have over the company's decisions as a shareholder. So, for example, if you buy shares of Apple, you are giving yourself proportional ownership of Apple, which is pretty cool. What's the difference between the stock market and the stock exchanges around the world, right? The stock market is a public marketplace, and this is a marketplace for securities and bonds to be bought and sold at various prices through a stock exchange. So, for instance, the New York Stock Exchange is the largest physical stock exchange in the world, and it allows buyers and sellers to interact with the stock market to buy and sell securities. Some other exchanges, such as the NASDAQ, are electronic exchanges that don't have a physical location. And the most common types of stocks that you can find are within stock market indices. So, stock market indexes is essentially a bucket, right? It's a collection of stocks that in some way represents the stock market as a whole. And the three most common market indices are the S&P 500, the NASDAQ, and the Dow Jones. So moving into the different types of stocks, there are common stocks, which anyone can own, such as you or I. And these stocks give you three different things, right? First, they give you voting rights. So shareholders are allowed one vote per share owned. They also might give you some sort of dividend payout. And these dividends are variable and may become higher or lower depending on how the company is doing. And lastly, there is a lot of potential for growth in these companies, such as Apple or Nvidia or even Tesla, right? There's a lot of growth potential for these companies, but at the same time, there's also a lot of potential for the company to find some drawbacks or some downsides. Next, there's preferred stocks, and these preferred stocks are usually owned by company founders or board members. And these type of stocks don't give you any voting rights, and any dividend payout that they have are fixed. You cannot change the amount of dividends you get from these stocks. They are set in stone and they usually don't fluctuate at all, right? So, regardless of if the company grows or loses value, your dividend payout is going to stay consistent. Moving into the two different types of markets, there is the primary marketplace and there's a secondary marketplace. The primary marketplace are made up of new securities, right? Reddit was a new security that just launched last year, I believe. So these new securities are called initial public offerings. And these IPOs allow company owners to sell their ownership to the public in an attempt to increase their cash reserves. So once the company exits this IPO stage and enters the secondary market, the traders and investors can move the price based on their own projections. And this is caused by supply and demand, which we'll get into in the next slide. Next, there's secondary markets. Secondary markets are where shareholders such as you or I are able to hold most of the control over the stock price because we're able to sell and buy shares to fluctuate the stock price. So in doing so, we're able to accrue profits or even losses based off of market conditions. And there are numerous variables that can cause stock prices to fluctuate. And listed here are four big reasons as to why a price can move, right? The main one being supply and demand. When there are a limited number of shares available for each stock, the demand can change based on how many people are interested in buying or selling that stock. This is economics 101. I'm sure you've heard of this before, but essentially, if more people want to buy up the stock, this will increase the price as the number of shares available decreases and the lower quantity of shares remaining will become more valuable. Right. And then if more people want to sell the stock, then the stock price will decrease as the number of shares available for purchase increase. Next, there's earnings and expectations. So if people expect certain performance from a company, they will typically buy more shares and hold these shares over time if the earnings reports, which are published every quarter, show a positive correlation with those expectations. On the other hand, however, if earnings come out and the projected revenue was lower than what investors projected, then the price will probably go down because investors aren't happy with the company's direction. Lastly, there are economic news, which can fluctuate price, and momentum, which can also fluctuate price. These are more of fundamental analysis, which we'll cover more in depth in later videos. However, all you need to know for economic news is that news such as FOMC meetings, CPI release, PPI release can fluctuate the price due to the overall market prediction or projection that investors have. And momentum is mostly based off of psychology of traders. If we see price moving upwards rapidly or even downwards rapidly, we are probably going to try to chase the trade, which we'll go into more detail later on. But if there's a large amount of people selling, we probably want to sell with them so we don't lose our profits for the day. Or if you're playing stock options, then you can profit by playing puts versus calls. On the other hand, if the stock price is climbing, then you're more likely to enter with calls or buy up the stock so you are gaining profit with everyone else. So, with all this, how do you profit from the stock market? Right? How can you make your money work for you? There's three main avenues of how you can profit. One is invest. Just invest in any stock that you think will grow in the long run, such as Apple, Tesla, Nvidia. These are all big corporations that have grown significantly in the past 10 years. Alternatively, you can also invest in an ETF where you're almost guaranteed an 8% annual return. Although this is only 8% compared to individual stocks such as Tesla, which may have a 50% growth rate, or Nvidia, which will have a 30% growth rate over a year. However, with this comes some downside risk because these stocks are more likely to fluctuate. Secondly, you can invest in dividend stocks. So stocks such as Coca-Cola or any REIT stock will pay you dividends every quarter as a thank you for investing or growing with the company. Lastly, you can trade options, which is what I do here at Astrios. I trade intraday stock option contracts and profit based off of intraday market movements, which we will get into in the next video. I hope to see you there.